the Federal Reserve is set to raise interest rates for the final time this year. And here's how it might impact you. The Federal Reserve hiked short-term interest rates by 0.50% on Wednesday, raising benchmark interest rates to their highest level since 2007, while indicating that additional rate hikes are on the way in 2023. The move on Wednesday takes the Fed funds rate to a range of 4.25%–4.5%, capping a year in which the central bank raised rates by a total of 4.25%. The Fed's rate boost of 50 basis points on Wednesday marked a slowdown from the central bank's recent rate hike pace, as the central bank had lifted rates by 75 basis points at each of its previous 4 policy meetings, its most aggressive run since the 1980s. We have taken aggressive efforts to tighten the stance of monetary policy over the course of the year, Fed Head Jerome Powell said on Wednesday. Please hit the like button for the YouTube algorithm, and don't forget to subscribe. We've covered a lot of distance, and the full impact of our hasty tightening has yet to be felt. Nonetheless, we have more work to do. In its statement announcing the decision on Wednesday, the Fed stated that it expects ongoing rises in interest rates, meaning that the Fed does not intend to cease rate hikes anytime soon. The committee anticipates that continued increases in the target range will be required in order to achieve a monetary policy stance that is sufficiently restrictive to return inflation to 2% over time, the Fed said in a statement. According to the Fed's new economic predictions released on Wednesday, benchmark interest rates will peak at 5.1% in 2023, an increase of 50 basis points from the previously estimated 4.6% in September. Officials then expect rates to fall to 4.1% in 2024, which is slightly higher than earlier predicted. These expectations come after Fed Chair Jerome Powell stated at the previous meeting that rates will need to rise above earlier forecasts in September. 7 officials expect rates to rise above 5% next year, with 5 forecasting rates around 5.25% and 2 forecasting rates as high as 5.6%. Officials do not expect core inflation to return to near target levels until 2024, with inflation ending this year at 4.8% before decreasing to 3.5% next year and 2.5% in 2024. Officials predict that unemployment would rise to 4.6% next year and remain there until 2024. According to the Fed, the economy will grow at a below-average rate of 0.5% next year before increasing up to 1.6% in 2024. When asked if these forecasts, with slowing growth and growing unemployment, suggest the Fed would tolerate the economy entering a recession, Powell answered, "I don't think it would qualify as a recession, since you have positive GDP growth." The Fed's action comes as inflation has begun to decrease in the last 2 months after reaching a 40-year peak this spring. The Consumer Price Index climbed 0.2% month-on-month in November, down from 0.3% in October and 0.6% in September and August, removing the more volatile food and energy components. The inflation numbers for October and November received thus far suggest a welcome slowdown in the monthly pace of price rises, Powell said. However, much more evidence is needed to be confident that inflation is on a prolonged decreasing path. By raising interest rates, the Fed makes borrowing more expensive, prompting consumers to borrow and spend less, thereby putting the brakes on the economy and lowering the rate of price increases. This is very excellent news for most consumers because prices are starting to stabilize, said Laura Veldkamp, a finance and economics professor at Columbia University Business School. That will provide a lot of comfort to families. However, some households will be harmed by this, she noted, referring to individuals with variable rate debt. For example, most credit cards have variable rates, which means they are linked to the Fed's benchmark rate. But it does not end there. Another rise in the prime rate will raise the cost of financing for many other types of consumer debt. Higher interest rates, on the other hand, mean that savers will earn more money on their savings. Credit card rates are at an all-time high and are continuing to rise, said Greg McBride, chief financial analyst at Bankrate.com. Auto loan rates are at an 11-year high, home equity lines of credit are at a 15-year high, and online savings account and CD yields haven't been this high since 2008. Here's how changes in the benchmark interest rate have affected everything from mortgages and credit cards to car loans, student debt, and savings. 1. Home loans. Although 15-year and 30-year mortgage rates are set and connected to Treasury yields in the economy, anyone looking to buy a new house has lost significant purchasing power, owing in part to inflation and the Fed's policy changes. While mortgage rates are reducing, they remain at a more than 10-year high, said Jacob Channel, senior economic analyst at LendingTree. The average rate for a 30-year fixed-rate mortgage is currently 6.33%, down from 7.08% in mid-November. 2. Charge cards. According to Bankrate, credit card annual percentage rates have risen to more than 19% on average, up from 16.3% at the start of the year. Even those with the greatest credit card should expect to be charged APRs of 18% and greater, said Matt Schultz, chief credit analyst at LendingTree. However, interest rates aren't simply going up on new cards, he added. The interest rate on your present credit card is likely to rise as well. Furthermore, because income has not kept pace with inflation, households are increasingly relying on credit cards to acquire basic essentials, making it even more difficult for those carrying a balance from month to month. 3. Car loans. Even though auto loans are fixed, payments are increasing as the cost of all vehicles rises, as do interest rates on new loans. So, if you want to buy a car, you'll have to pay more in the coming months. The average interest rate on a 5-year new auto loan is now 6.05%, up from 3.86% at the start of the year, while buyers with stronger credit may be able to negotiate better financing conditions. Still, the sticker price of the automobile, not the loan rate, is the primary cause of an affordability crisis, according to McBride. 4. Student debts. The interest rate on federal student loans for the 2022-23 school year has already risen to 4.99%, up from 3.73% last year and 2.75% in 2020-21. It's not going anywhere till next summer. Each May, Congress establishes the interest rate for federal student loans based on the 10-year Treasury rate. The new rate takes effect in July. Private student loans typically have variable interest rates related to LIBOR, prime, or Treasury bill rates, which means that if the Fed rises interest rates, those students pay more in interest. However, how much more depends on the benchmark. 5. Savings accounts. On the plus side, interest rates on some savings accounts have risen as a result of consecutive rate hikes. While the Fed has no direct influence on deposit rates, changes in the target federal funds rate tend to be connected. Savings account rates at some of the larger retail banks, which were near rock bottom throughout the majority of the COVID epidemic, are now averaging 0.24%. Top-yielding online savings account rates can reach 4%, according to Bankrate, which is significantly higher than the average return from a traditional, brick-and-mortar bank. Interest rates can fluctuate significantly, especially in today's interest rate climate, when the Fed has lifted its benchmark rate to its highest level in more than a decade, DepositAccounts.com founder Ken Tuman said. Banks profit from customers who do not monitor their interest rates, Tuman explained. Nonetheless, any money earning less than the inflation rate loses purchasing power over time.